Since they no longer have faith in the SWIFT system, central banks continue to purchase gold. A dramatic shift in the money supply is possible. There has been a tremendous change in institutional attitude, and the global gold market seems to have reached a critical juncture marked by the revelation of long-running price repression. More and more proof is appearing that for decades, gold's accurate assessment has been obstructed by artificial procedures. Those limitations, however, are starting to crumble as central banks across the globe rid themselves of paper gold contracts and reject Western-controlled financial institutions. There is going to be a split in the market for gold in the form of physical bars and the synthetic variety that trades on Western markets.
The physical market may reprice gold significantly higher when that imbalance eventually breaks, revealing how undervalued it has been throughout. In this episode, precious metals expert Mike Maloney and SOAR Financial Partners founder and managing director Kai Hoffmann discuss how the London Bullion Market Association's manipulation of gold prices has unwittingly created a massive opportunity for wealth. They cite statistics that show the price of gold might be above $50,000 per ounce right now if trading were to take place outside of London's trading hours. This shift in institutional thinking is being marked by the public endorsement of gold and silver allocations by big institutions like JP Morgan and Morgan Stanley. This might be the last stage before gold escapes artificial limitations, what with central banks amassing, huge gold lease unwinds, and fiat-based system flaws forming. As the decades-long price control system crumbles and real money returns, we are seeing history unfold before our eyes. We are now going to show you the excerpts from their interview. Please subscribe to our channel and enable the bell symbol to receive timely updates before we continue to discuss this. Please enjoy the video and thank you. Nick Laird of Gold Charts RUs has sent this. The ICE has told me that I cannot show the LBMA silver and gold fixes on my website because I do not possess the necessary license. See this ICE here. That's right, it's the ICE. The LBMA pricing are derived from that. They didn't hide these for what reason? The first thing someone should do if they are suspected of a crime or face criminal charges is to collect all of the relevant documents and then destroy them in a paper shredder. So that wonderful investigative journalists like Nick Laird can't do their jobs. They're attempting to destroy all evidence. The math is simple. Graphed in red is the current gold price. Assuming that all trading took place during London hours, the black line represents the gold price. What this means is that gold's value has dropped from $35 in 1971 to $2.24 today, based on data collected from the AM fix through the PM fix, assuming that this is the sole trade that takes place throughout the day. Assuming that all trading takes place at the end of the London trading session when the rest of the world is also trading, and multiplying the percentage change in price during that time by the previous day's close of the percentage change for all trading that took place outside of London, which includes the rest of the world, you get $50,000 worth of gold. A wonderful opportunity has presented itself to precious metals investors in the form of this illegal price suppression, and this is happening slowly but surely. The price will skyrocket as they lose control. If you apply pressure to a spring now, it will bounce much higher when you let off of the handle. Their illegal behavior presents you with a fantastic chance. Mr. Groman Jr., Luke, I am really appreciative of this fantastic chart. S&P 500 is the red line. Since August 15, 1971, the blue line represents the S&P 500 denominated in gold. The index has lost 21% of its value. At the gold price, it has fallen 21%. Please allow me to examine this. Prices of gold are over $1,000 higher. Here we are in the 20s. They shielded you from a profit of $1,100 or 45% of your investment within the same time frame. Geiger Capital then. The correlation between the price of gold and the 10-year inflation-protected treasury is evident, but it is worth noting that gold stopped tracking U.S. real rates in 2022. This is in contrast to the 10-year minus inflation, or real rates, which are slightly different. So far, the correlation has been about 0.97 or 0.98, which means that 97 or 98% of the time they are identical. But in 2022, they begin to diverge. Why? The United States took action against Russia in 2022, refusing to merely sanction the country for its invasion of Ukraine. Instead, it proceeded to seize Russian assets and reserves, sending a message to the world's central banks that America had turned into an unruly nation that violated the rules of the international monetary system and seized foreign assets without due process. The 10-year minus is a little different because it represents the 10-year real rates relative to gold. Spot gold versus total gold ETF holdings is quite intriguing, and you didn't notice this massive dip in the other chart, but the correlation is mind-bogglingly high. Then there's this abrupt divergence at the start of 2022. Since the correlation is so perfect, we can deduce that the West was once the primary driver of the gold price at the beginning of 2022, but that something happened and now the West isn't. The divergence occurs between the end of 2022 and the beginning of 2023. Our gold holdings have been depleted. As we've been selling, central banks around the world have been doing things like dehypothecation and winding down all those gold leases. But I'm not claiming it is because I don't have any proof. This is what I'm calling a theory. Since these things are being unwound, there are fewer and fewer ounces of virtual gold floating around. Since there are fewer and fewer ounces of physical gold in circulation relative to the amount of money in circulation, the price of gold is bound to rise. It's interesting that these charts are diverging around the same time. According to Spencer, the dollar's value relative to gold has dropped by half in the last 3 years. Try to put yourself in our shoes. His assessment that you have relocated to a developing nation was spot on. A few days after Correlation Economics released their findings, J.P. Morgan chimed in with their suggestions for your portfolio broken down by asset class: stocks, bonds, credit, currencies, and commodities. Lengthy, made of gold, silver, and platinum. I will address platinum shortly. Petroleum, basic metals, and short sales. Going short on oil and base metals indicates that you anticipate economic hardship. Your prediction is that oil and base metal demand will fall. Cars and homes both rely on base metals, and since copper is used for plumbing, wire, and many other things, this could lead to a recession. A disaster is imminent. Golden, silver, and lengthy. It is important to take precautions here. Is that platinum? Palladium is a valuable metal. It is a metal used in industry. In essence, it serves as a catalyst. When platinum is too pricey, palladium or platinum is used instead in your car's catalytic converter. Yet platinum has never been a medium of exchange. Right now, it isn't money, and it never will be. Precious metals such as gold and silver have served as money and a safe haven for over 2,000 years. Investors flee to these assets in times of crisis, as predicted by those who are shorting oil and base metals. Neither palladium, nor rhodium, nor platinum. They get a flurry of activity around precious metals. Farewell, precious metals. Why they would suggest platinum is beyond me. Now let's proceed. Bald Man Cash was incorporated into my silver upgrade. 2 weeks ago I wrote about this. The one he mentioned 2 weeks ago is the same one I was using. The 60-40 portfolio is about to meet its demise. If we allocated 20%, my predictions would be completely wrong. 20% of 40% is 8%, and that's what I was advocating. However, this may be quite significant because of what they desire here. No, it's enormous. Out of this world. This is like head-scratchingly amazing. The chief investment officer at Morgan Stanley prefers a 60-20-20 portfolio. Accordingly, Morgan Stanley suggests selling half of your bonds. Typically, it's 60-40. A 60% equity portfolio and a 40% bond portfolio. Eliminate 50% of your bonds rather than 20% of 40%. Moreover, release half of your bonds, and if you put half of that money into gold, you'll have a 60-20-20 portfolio. Globally, the bond market ranks among the most extensive marketplaces. The scale of this is quite astounding. The Gold Telegraph has breaking news. The Indonesian Grasberg Block cave mine, owned by Freeport-McMoRan, has announced a force majeure on all committed shipments. Holy cow! The mine in question does, in fact, contain one of the world's most extensive gold and copper reserves. Now, as a result, the market is seeing a decrease in supply. Freeport-McMoRan, like most large corporations, would typically lease gold from a central bank in such a scenario. The head honcho of the New Orleans Investment Conference, to which I will return in a moment, Brian London deserves my gratitude for organizing this. He probably doesn't say anything. As gold prices soar, the government at the peak briefly brings up the Fort Knox audit before going silent. True, central banks do in fact lease gold, the whole American gold holdings with the exception of this little fragment, which constitutes less than 1% of the total gold owned by the Treasury. Pretty about everything has been re-hypothesized. The United States Federal Reserve, our nation's central bank, has been granted the title. It is due from the Federal Reserve. However, it has undergone more hypothecation after then. Therefore, it continues to be lent out on successive contracts. However, in a typical situation, they would lease gold from a central bank, pay the agreed-upon amount in full, and then repay the loan plus a couple percent interest. The result is that the central bank earns 2% interest on the gold. So, if they are currently attempting to cancel all of those gold leases, it would explain their relative quiet and drive up the price of gold. As a number of macro dynamics come together, the unstoppable rise in gold prices has captured the interest of almost everyone. Investors' appetite for physical assets has been rekindled by a confluence of factors, including a declining dollar, increasing global debt, and ongoing geopolitical turmoil. The continued aggressive purchasing of gold by central banks has further cemented the precious metal's status as a reserve asset outside of the Western financial system. Nevertheless, the most significant indicator is the resumption of ETF inflows in both North America and Europe. This indicates that institutional capital is once again pouring into the metal market after being absent for an extended period of time. This mood is reflected in retail trends. The vault operators have reported a significant level of physical demand, with some investors selling their earlier stakes for a profit, and others actively buying more in anticipation of price increases. Even while growing energy and labor costs are putting strain on operations, producers are enjoying extraordinary profits due to gold's near-record levels. Notwithstanding these obstacles, very few are able to put out a compelling bear argument. The long-term trend of gold is unaffected by factors such as the mounting global debt, declining faith in fiat currencies, and persistent geopolitical tensions. In a nutshell, the current gold price discovery period is being characterized by long-term structural change rather than speculative price action. Returning to the interview, let us proceed. The movement of gold excites me. Obviously, it's a huge step, perhaps even overly aggressive, but once again, momentum. In the end, it's all that matters.